This is what a crypto portfolio looks like when it's rebalanced, and this is what it looks like when it isn't. Here's the reality. Most people assume dynamic rebalancing is some advanced trader wizard technique reserved for professionals only. But the truth becomes obvious the moment you look at an unmanaged portfolio. Do not invest unless you're prepared to lose all the money that you invest. One asset suddenly balloons, the pie chart looks lopsided, and the original plan quietly disappears in the background. So what actually happens when a portfolio isn't rebalanced? Exactly that. Risk becomes unpredictable. One coin takes control and exposure shifts far away from the intended allocation. But what happens when a portfolio is rebalanced? The structure holds, risk stays consistent, allocations remain aligned with the original strategy, and the entire process naturally pushes you toward buying low and selling high without overthinking it. Here's the simple explanation. Rebalancing means adjusting asset percentages back to their targets after market movements distort them. If the plan was 50% Bitcoin and 10% in other assets, but one of them surges 20%, rebalancing brings everything back to where it belongs. Most investors follow one of two approaches: time-based rebalancing, choosing a specific day or a week and adjusting on schedule; threshold-based rebalancing, letting the portfolio correct itself whenever an asset drifts too far from its target. And yes, those methods work. Multiple studies show that regularly rebalanced portfolios often outperform those left untouched, even in simulations where rebalancing happens hourly. The reason is simple. The structure forces rational behavior, selling after strong gains and buying after meaningful dips. But there is a balance to maintain. Rebalancing too frequently introduces unnecessary trading fees. Rebalancing too infrequently can miss key opportunities. That's why many investors choose weekly schedules or combine both time-based and threshold-based triggers. The real takeaway is that if you want to maintain a balanced, disciplined portfolio without manually tracking every market movement, the economy lets you automate your rebalancing with a simple time-based or threshold-based rules. Check it out at economy.com.